Today, we're going straight on the offensive against the traditional financial industry. We're going to expose a massive, incredibly profitable myth about financial expertise, and we're replacing it with a clear blueprint to build unbreakable wealth. The secret? Perfectly boring habits. Seriously. If you're ready to stop playing Wall Street's frantic, high-stress video game and actually start building a pipeline of generational wealth, you're exactly where you need to be. Okay, let's take a quick look at our roadmap. We're breaking down 15 unsexy, brutally honest habits into 5 core pillars. We've got the Wall Street illusion, the power of average, muting the financial noise, mastering investor psychology, and finally, setting up the autopilot wealth machine. Let's get right to it. We're kicking things off with pillar number 1, the Wall Street illusion, or the myth of financial expertise. And we really need to start by shattering an illusion that's quite literally designed to intimidate everyday investors like us. Think about the classic Wall Street image. You picture the stock exchange floor, right? Expensive Italian suits, people screaming into telephones, flashing red and green monitors everywhere. It intentionally sends the message that managing money is this highly complex game you couldn't possibly win without an advanced degree and paying astronomical fees. But the reality of true generational wealth? It's quiet, it's simple, and it's built entirely on incredibly boring habits that consistently crush the returns of those stressed-out experts. The hard data backing this up is honestly mind-blowing. Over a 10-year period, 85% of highly paid, active mutual funds completely underperform their simple benchmarks. Think about that for a second. That means if you pay a team of highly educated experts to actively manage your money, you literally have an 85% chance of doing worse than if you just bought a simple, boring index fund that tracks the entire market. The so-called experts aren't beating the game. They're losing to it. So that brings us right into section 2, the power of average, and why embracing a totally boring strategy is actually your best move. The real secret sauce here is what's called the 85% solution. Look, we all suffer from decision paralysis sometimes. You look at thousands of mutual funds and crazy complex track strategies, and you just freeze waiting for a mathematically flawless plan. But here's the truth. Doing nothing is absolutely the worst financial choice you can make. Getting 85% of the way there by just setting up a decent, low-cost investment plan today is a massive victory over endless, paralyzing research. Taking action always beats becoming a theoretical expert. Always. To put the danger of chasing perfection into perspective, consider the number 533 decillion. That's a number with 33 zeros behind it. Finance professors figured out that if you had invested $1,000 into every single initial public offering since 1960 and perfectly rolled it over every month, you'd theoretically have $533 decillion. Wow, right? But here's the massive catch. You only get that if you magically capture every single rare winner. Missing just one needle in that giant haystack completely wipes you out. Chasing the next big thing is just a mathematical trap. So, to actually win, you've got to adopt these boring habits. First, embrace perfectly average market returns. Second, stop seeking the needle in the haystack. Honestly, just buy the entire haystack through a total stock market index fund. And third, minimize your trading turnover to almost zero. Massive studies show that hyperactive traders basically destroy their wealth with costs, while patient investors who barely touch their accounts vastly outperform them. Now let's tackle the nonstop national video game of financial media in our third pillar, muting the financial noise. Protecting our information diet is absolutely critical here. There was this fascinating experiment done by a psychologist named Paul Andreasen, and the results speak for themselves. He found that investors who received frequent news updates on their stock portfolios earned exactly half the returns of those who received absolutely zero news. Let that sink in. People kept completely in the dark who just lived their normal lives, made twice as much money as the folks constantly monitoring the media. Daily market news is literally just noise designed to trigger your emotional fear center. And please, don't get distracted by what I call the 0% transfer game. Take this guy Mike, for example. He spent hours moving a $40,000 emergency fund between different banks every few months just to earn an extra 0.6% in interest. When you break the math down, his exhausting little game earned him exactly 82 cents a day. He wasted his most valuable asset, his time, chasing literal pennies when he could have been optimizing the massive structural pillars of his actual wealth. You have to relentlessly mute the noise. Turn off the financial television networks. Just turn them off. Ignore the Chicken Littles. You know, pessimism always sounds like someone trying to save your life, while optimism just sounds like a sales pitch. But historically, the market always trends up over long periods. And crucially, refuse to play a short-term day trader's game. When a TV pundit screams to buy a hot stock, they have no idea what your 30-year timeline is. Ignore them. All of this leads us to what might actually be the hardest challenge of all in Section 4, mastering investor psychology, cultivating the true mindset of wealth. Here's a huge relief. You do not need perfect accuracy to build wealth. What you really need is to rely on the math of tail events. A tail event is just a tiny minority of outcomes that end up accounting for the vast majority of your overall results. In a highly diversified portfolio, half your investments might fail or do absolutely nothing, but one or two, they'll explode in value, generating thousands of % in returns. You essentially accept owning some losers because it mathematically guarantees you'll own the rare, massive winners. You also have to ruthlessly avoid ego-driven lifestyle bloat. We are so conditioned by society to think wealth is a $100,000 luxury car. But honestly, the only thing that car proves is that the owner has $100,000 less in the bank today than they did yesterday. True wealth is what you do not see. It's the luxury car not purchased, the diamonds not bought. The ultimate boring habit of the rich is just maintaining a massive gap between their ego and their income. Even the absolute top experts prioritize peace of mind over spreadsheet perfection. Take Harry Markowitz. He was a brilliant economist who literally won a Nobel Prize for inventing modern portfolio theory. But when it came to his own money, he used a shockingly simple 50-50 split between stocks and bonds. He completely ignored his own mathematically perfect award-winning formulas. Why? Simply to minimize his future psychological regret if the market crashed or soared. He optimized for how well he slept at night, not for the absolute highest return. We also fundamentally need to redefine our vocabulary around market crashes. When the market plummets, most people view it as a fee, a brutal penalty for doing something wrong, kind of like a speeding ticket. Naturally, they panic and sell. But the truly wealthy view volatility as a fee. It's just the mandatory admission cost for long-term financial freedom. Think of it like happily paying for a Disneyland ticket to get an unforgettable experience. It's the price of admission. To lock your psychology in place, try these habits. First, write and sign an investment owner's contract with yourself when you're calm. Declare that you will never let a panicked herd make your decisions for you. Next, to stop yourself from emotional tinkering, only rebalance your portfolio on 2 holidays a year, like New Year's and the 4th of July. And finally, taking a page from our Nobel Prize winner, always aim to be mostly reasonable rather than coldly, perfectly rational. Finally, we arrive at our last pillar, Section 5, the autopilot wealth machine. This is all about execution, putting this entire blueprint onto permanent, gloriously unsexy autopilot. To beat the experts, you actually have to remove your own willpower and daily decision-making completely out of the equation. You do this through dollar-cost averaging. It's a boring, mechanical system where a predetermined amount of money is automatically invested on a strict schedule. When the market is booming, it naturally buys fewer expensive shares. But when the world is panicking and the market is crashing, your fixed amount automatically stretches further, buying way more shares at a massive discount. The sheer beauty of this is the simple pipeline you set up exactly once. Step 1, your paycheck arrives. Step 2, an automated transfer triggers the very next day. Step 3, the system automatically buys low-cost index funds. And step 4, you go live your life. You don't log in, you don't check the scary news, and you don't burn human willpower. You just allow the relentless, beautiful math of compounding to do all the heavy lifting in the background. Putting your portfolio on autopilot basically immunizes you against the terror of a crash. Imagine a panicked coworker running up to you, freaking out about what the market is doing today. Because of your system, you can calmly look at them and respond with the most powerful phrase a long-term investor possesses. I don't know, and I don't care. While they panic, your automated system is just quietly buying assets on sale. So, we've seen how true wealth is built. It comes from accepting average returns, tuning out all that toxic noise, ignoring hot stocks, and putting your money on an unbreakable, automated schedule. Stop trying to outsmart a chaotic world. Instead, I want to leave you with this. Which of these unsexy, perfectly boring habits will you implement before you go to sleep tonight? Will you set up that automated transfer, or maybe draft your owner's contract? The choice is yours. Start building your quiet riches today.